You're seeing tremendous fluctuation in the oil market right now because the thesis on oil has sort of changed 180 degrees throughout the entire period from 2003 really until about June of 2008. The view on oil was basically that their growth in demand was going to outstrip the growth in supply. By the summer of 2008, as investors started to note the weakening of the economy in the United States and Europe, which both account for about half of global oil demand, the oil thesis starts to get turned on its head and supply can now easily catch up with oil. When you combine a deteriorating fundamental picture with the fact that many of the speculative participants in the oil futures market have had their access to credit frozen, and by this I mean hedge funds, it sets an environment where oil can fall from what was clearly a speculative peak at kind of the $145 level down to where we are at present in the low 70s. I believe that yes, over the medium term, the OPEC production cut will have an effect on tightening the supply and demand situation, and in time will filter through to the price of oil. OPEC members have actually shown a lot more discipline in adhering to cuts and as well as production increases in the last several years than they had previously. They announced the cut in October of 2008 of 1.5 million barrels. The market had sort of been looking for a 2 million barrel a day cut, which is why the oil slide has continued. Gold sometimes gets referred to as a safe haven, but bonds are a safe haven. If investors want a safe haven, they should buy Government of Canada or Government of US bonds. That's the only safe haven. We invest in gold because it is a good diversifier. Over time, and once again in 2008, gold has consistently zigged while the equity markets zag. So it's a good diversifying element within the portfolio. I'm actually quite surprised that gold has done so poorly. It's actually outperformed the base metals and oils, but for the gold bug enthusiasts, they've had a perfect confluence of events in terms of the destabilization of the global financial system and so forth, and yet gold is now almost $300 off its high, and with investment fears on the wane, it's difficult to see what will turn it around in the short term. One thing I'd encourage viewers to think about is that the world's leading resource firms like BHP, Billiton, ExxonMobil, and so forth, they don't make their investment decisions on the basis of a short-term outlook in spot prices. And if that approach is good enough for them, it's probably good enough for most Canadian private investors. What I mean by that is they should focus on companies that have diversified assets and that are the low-cost producer. A commodity is just that, it's a commodity. Royal Dutch's light oil is just as good as ExxonMobil's light oil, so the key is to have low production costs. This will enable them to generate cash flow throughout the cycle and build their businesses accordingly.